everyone. This is Cassie Lehman. I'm the president of Beacon Wealth Consultants, and today we have a special report for you. I invited Hillary Sunderland to join us. She is a CFA. She is our portfolio manager, our chief investment officer at Beacon Wealth, and we wanted to do a quick interview with her to talk about some of the changes in the market yesterday. So Hillary, welcome to our video today.
Thank you, Cassie.
So Hillary, I'm going to just start off with the question that is on everybody's mind. What the heck happened yesterday? There was a big drop in the market. What is going on?
Yeah, so yesterday that was more indicative of a panic type selling day. What happened was interest rates have been going up, which is widely expected to occur, but the 10-year Treasury, which is a key level, hit its highest level in 7 years. And so because bond yields have been rising, there's concern about some inflation and continued trade issues with China, it's really stoked some shorter term fears in the markets. And so we saw a big downdraft in the markets, a lot of that concentrated in tech names. Tech has been one of the best performing parts of the market this year. And so whenever it sells off, it takes a lot with it because it's a big part of the indices. So we weren't surprised by the sell-off, but certainly the swiftness of it is always concerning to investors.
Sure. So you do some technical analysis, and so that's something that everybody might not be familiar with, but you're really looking at these indicators on a regular basis, looking at momentum, how are things changing. Was there any indication that you had that some of these changes were coming?
Yeah, that's a great question, Cassie. So we do look at those on a regular basis, and we were starting to see some weakness in certain areas of the market. So smaller stocks were starting to sell off a bit, and the tech sector in particular really started to sell off earlier last week. And so we saw some of the key parts of the market start to decline. However, certainly the magnitude of the pullback was not expected when you see that much of a drop in a single day. However, we did see some signs of weakness, but not broad-based enough to really elicit a lot of concern. The economy is still doing very well. Usually bear markets, which is defined as a drop of 20% from a high, usually bear markets are accompanied by a recession most of the time. And there's still less than a 20% chance of a recession occurring. And so what that tells us is that even though we have a pullback in the markets right now, that does not mean it's going to be another 2008 type environment. Because usually if you have a big pullback in the markets and it's not accompanied by a recession, the pullback is much shorter in time frame and much shallower in the magnitude of the decline.
And that's not really such a rare thing, right? I mean, that's how markets work.
Yeah, it really is. What we have here is a slide of annual returns and intra-year declines going back to 1980. And how to read this chart quickly is the gray bars that you see above the line. That is the ending return of the S&P 500 for a calendar year. And the red dots below the bars are the maximum decline within any given year. And so what you can see here is that on average, you experience a decline of at least 10% once per year. And since 1980, the average inter-year drop is about 14%. So it's very much expected to get a fairly large pullback in any given year. However, the nice thing to note about this is even though the average inter-year decline of the stock market is about 14%, in 29 of the last 38 years, we've still ended the year with a positive return. So 75% of the time, historically, even though you can see sharp pullbacks like the one we just experienced, 75% of the time you still end up positive for the year. So, investing is not a straight line. I wish it was. It would make my job much easier. This is very much to be expected, although it can be disheartening at the time of occurrence, for sure.
Okay. Well, I like the fact that you're talking about percentages. I think that's something that people can really relate to. So they might see a big number, and of course there's always a lot going on in the news and that gets us stirred up. But so, to see a market drop of 830 points in the Dow, seems like such a huge number. It would give you a stomach ache. But can you relate that to percentages to give us a little bit of comparison there?
Sure. So yes, the media likes to sensationalize numbers. And yesterday, we saw a lot of news headlines about the decline of over 800 points in the Dow Jones Industrial Average. So at current levels of the Dow Jones, on a percentage basis, it's much less than what we would have talked about, back in a 2008 type environment, when the market was trading below a level of 10,000. 800-point drop back then would have been an 8% decline in a single day. Now we're talking about a 3 to 4% decline, depending on what market index you're actually looking at here. So while the number may seem high, we have to remember that this has been one of the strongest bull markets in history. We are at much higher levels today on the indices than we were just 10 years ago. And so a point drop of 300 points or 500 points or 800 points is not near the magnitude on a percentage basis of what we've witnessed in the past. And so we always need to take those numbers with a grain of salt and remember to convert them into percentages to see what we're really talking about here.
Yeah, good. Now, Hillary, people who are more aggressively invested will, of course, if they're looking at their numbers every day, they'll see a big impact from yesterday. But I want to talk a little bit about this year to date and in our conservative investors. So there's a word that you use often to describe the markets this year, which is sideways. So can you tell us a little bit about what you mean by the market being sideways and how that has impacted our investors and I guess specifically our conservative investors who may be more in a fixed income place?
Sure. Yeah. So the markets have been moving sideways for much of the year, and what I mean by that is it's moving within a trading range. So the high of the market will hit a high, and then it'll consolidate within a particular range to a more of a near-term low, and then when it goes back up, it stops near that high again, and then it comes back down near the low. So basically what that means is the market, there's periods of time when it's moving higher, but then there's also periods of time where it's moving lower. And so when you kind of add all those together and look at it as a whole for the calendar year, you don't really have much upside to talk about. This latest pullback in the market yesterday, we closed just below the highs that we reached earlier this year. So we haven't really been going anywhere per se on a return basis. For more conservative investors, it's been a tough year. The reason for that is our conservative investors are more oriented toward bond investments and also more defensive sectors and parts of the market. We tend to tilt the more conservative portfolios toward dividend-oriented stocks. Whenever you have a dividend-oriented stock that's growing its dividends over time, that gives you more of a constant yield stream, which our more conservative investors are looking for. And it also allows investors to kind of hedge their downside risk a little bit. When you're more tilted toward dividend-oriented stocks and the markets fall, like we saw yesterday, they tend to hold up a little bit better. And all that being said, dividend-oriented stocks have really been left behind year to date. What's been leading the market higher are more growth names such as tech, which is the biggest part of the S&P 500 index. And so when you see news headlines that the S&P 500 and the Dow Jones are hitting hitting all-time highs as they were in the third quarter of this year, our more conservative investors weren't seeing the same amount of participation on the upside because they've been more tilted toward your dividend-oriented names. Likewise, on the bond side, yields have been rising this year, and what happens when yields or interest rates rise on bonds is that initially the price of bonds declines. Because those portfolios are more oriented toward bond investments, you haven't seen much upside there either. However, we have positioned the portfolios on the fixed income side to try to hedge some of that rise in interest rates. And so all of the funds that we're currently invested in within our fixed income position in the portfolios have outperformed the broad bond market. It's just still, on an absolute basis, they're still fairly low for the year, considering what clients have been used to getting over the last 5 to 10 years.
Okay, thank you. Thanks for that update. So we get tempted when we see this activity in the market. You see a drop, you see a rise, and people want to react to that. They say, get me out of the market or jump in the market. They want to really react to that. So what would you say to someone today, this week, who might be concerned about this drop in the market and maybe a little fearful and wanting to make some changes in reaction to that? What advice would you give them?
Sure. Well, one of the things I like to show is a slide by JP Morgan, which shows 20-year returns by different asset classes. And you can really just zone in on the orange bar there, which is the average investor. So there's a study done by a firm called Dalbar every year, which looks at the returns investors are getting in the market. And the interesting thing here is that the average investor over the last 20 years has earned returns of 2.6%, whereas your typical balanced portfolio, which is the light blue bar there, the one that says 60-40 underneath, has had annualized returns of about 6.4%. So almost 3 times the returns is what an investor would get just by staying in the market. But the orange bar is really representative of what's going on in investors' minds and their behavioral biases. And so it's study after study shows that investors can get fearful very quickly. I think that's going on this week because I've already gotten several emails from our clients about what's going on in the markets and should I remove my portfolio in reaction to this. But one of the things that I want to point out here is that we are looking at these portfolios on a daily basis. We make changes to the portfolios as warranted by our longer term outlook. And right now, the economic outlook is still very good. So while we can have these shorter term pullbacks, I would really urge you not to make any rash moves in your portfolios based on what happened over the last few days. It's very well known that investors sell out at the wrong time and they tend to buy in at the wrong time. And that's what that orange bar is showing you there. On average, a lot of people make the wrong moves at the wrong time. And so I would just encourage each of you to really think about your long-term plan. We are a firm that focuses on financial planning. We have a probability of success for each of you. And 1 week's worth of returns is not going to wreck what's going on with your overall financial plan. However, making rash moves right now and changing your overall positioning for the next few months, that can significantly affect your plan. So I would just encourage you to talk to your advisor about that and try not to make any fearful moves at this time.
Great. I couldn't have ended up with any better message than that, Hillary. So thank you so much for taking time today. As I mentioned, Hillary is looking at these portfolios all day, every day, making changes. So I know this is a really busy time for you, and we just really appreciate all of your hard work and taking the time to talk to us a little bit about what's happening in the markets. And as Hillary mentioned, if you have some concerns, you want to talk through this, please don't hesitate to call your advisor and have some conversations about that. We'd be glad to talk with you. Take care. Have a great day.
Thank you.